asset today with the hope of making sure that you sell it at a higher price in future. So for example, you're buying a plot today at 100,000 with the hope that you'll sell it at 150 or 200,000 months later. That is basically what investment is. And investment can be divided into either a formal way of investing or informal way. The informal way is really what you do, like a chama, a merry-go-round. We give you money today, and then next time it will be someone else. Or then you can actually do personal investment by just going to the Nairobi Securities Exchange and buying shares by yourself, or things like that, or even just starting a business, a hair salon. That is really an informal way of investing. There is now the formal way of investing, or investing in the securities market, and this involves things like investing in pooled funds, contribution to the staff benefit schemes, investing in a SACCO, or those are the kind of ways that have been that you can actually use for investing purposes. So there are a couple of things that you need to look at when you are deciding for what to invest. But the key things are like, what is the returns that you're going to get from that investment? What are the levels of returns and the type of returns? Because also that determines the taxation that comes with it. Your risk profile, how much risk can you take? Remember, we said that depending on your age and things like that, it determines how your risk appetite is. Then liquidity of the various assets. So for example, if you wanted to invest some funds to take your kid to school next year, it is not wise for you to buy a plot with that money, because it might not be easy for you to liquidate that money. So there are a couple of factors that you need to look at when you are investing or that determine what you can invest in. Age is one of them. Remember, the younger you are, the more risk your risk appetite is higher, because you have a long time for you to recover even from any shocks. Then the income level. For people with higher income levels, they can take more risks, and so they can invest in more volatile assets. Then the level of sophistication, and sophistication here is really just how much do you understand the financial, how financially literate are you? So for the people who are more financially literate, then they can take more. They can take more risky assets. So, for example, people who invested in Bitcoin, I think most of them should have been a bit sophisticated, as opposed to just maybe someone just out in the street who does not understand finance that much. The amount of net worth, how much money do you have? Again, last week we looked at net worth. It's just looking at your net assets minus your net liabilities. Are they positive or negative? If you have a high net worth, then you can take more risk, because some bit of money being lost then might not affect your overall financial position. Then the investment knowledge is key, and this is really gained by reading a lot of literature and reading the newspapers, because you can see a lot of things that are happening globally and also in the market. So key is just make sure that you look at your risk profile, your return expectations, and your liquidity requirements. And this goes back to understanding your situation and understanding your financial goals as you come up with the investments that you need. So what I have done is just look at the key, some of the key investments and their return potential and their liquidity potential, their liquidity. So shares, the return is high if you select the shares well. The risk profile is medium to high. And if you look at the risk profile, it's also medium to high, because you can easily sell the stock market. Then property development, the potential return is high. The risk profile is high as well, but the liquidity is very low. So you cannot sell an incomplete building. So that again affects your liquidity. Property, rental, for example, potential return is high, risk profile is high, but the liquidity, the property liquidity there is also low, not very low, but low. Then government bonds, the return potential is medium, risk profile is low, and liquidity is low. Actually, for government bonds, they are actually called risk-free, because we do not expect the government not to be able to honor the payments. Deposits and cash, then the potential return is medium or even low, I would say. Then the risk profile is medium, and the liquidity is high, because you just need to call the bank and get back your money. Unit trust, their returns are potentially high. The risk profile is medium. and liquidity profile is high because you just need to do working days and you have your money. And so we have also seen unit trusts whereby you can actually transact on real-time basis through your M-Pesa. So liquidity is very high. International equities, the potential return is high, but there's a lot of risk. The risk is between medium to high, depending on where you're investing. If you're investing in emerging markets, the return is low. If you're investing in more developed markets, then the return is high. The profile is high. Then the liquidity is high because you can easily sell and repatriate the funds back. So depending on where you are and what your financial goals are, then you can select the stocks that you want. So today, I wanted to look at formal ways of investing, and we shall only look at one part of it, pooled funds like unit trust schemes, and then the shares, the investment in shares, then the following week fixed income and retirement benefit schemes. So in terms of pooled funds, last week there was a question of what is a pooled fund. It's really just a portfolio whereby different people put in their money, they select professional fund management expertise. And then that fund manager invests in various assets, and as they invest in various assets, then you get the return that is distributed to everyone. So like for money market, what happens is at the end of the day, you actually have the average yield that is distributed to everyone. So the different types of pooled funds are unit trusts, and under unit trusts, we have money market fund, we have equity fund, we have balanced fund, and we have more specialized funds that are funds. So for unit trusts, they are regulated by the Capital Markets Authority, and there are a couple of providers that offer unit trust, and we shall look at them at the end, towards the end of the presentation. I'm just muting some people who haven't muted. Sorry, we can continue. Apologies for that. So in terms of unit trusts, they are regulated by the Capital Markets Authority, and we shall look at the various players there. So I said they are money market funds. Money market funds, they are more short term, and they are largely invested in fixed income. Then equity funds, as the name says, it's really investment in the stock market, and the balanced fund, which really for medium risk clients. Then we have retirement benefit schemes as the other type of pooled fund. And under retirement benefit schemes, they can be of two ways: occupational schemes, and occupational schemes are actually started by the employer, where you can also make contributions and even additional contribution if you wish. And then the personal pension schemes, where you subscribe to. They are also offered by fund managers and fund administrators. When we get again to retirement benefit schemes, we shall look at more details about that. So in terms of the key structure of pooled funds, who are the key parties to a pooled fund? You must have a trustee. The trustee is the person who takes care of the investment of the clients. They make sure that the fund manager is investing in line with the investment policy statement, so that the objective of the clients is achieved. Then we have the custodian. The custodian is the bank that holds the funds and actually executes all the investments. So for you to be a custodian, you must be a bank, and you must have the capability and a license to operate as a custodian. Then we have the fund manager. The fund manager is the person who makes all the investment decision. Then we have the administrator. The administrator is the person who keeps the records of the investors to ensure that and ensures that the correct books of accounts are maintained. And in case of a pension scheme, they actually distribute. Then we have the regulator. In this case, we shall talk about the Capital Markets Authority and the Retirement Benefits Authority for the various schemes. Then we have the factors to consider when choosing a fund to invest in. The first one is investment horizon, the return, the risk profile of investors, and the investment knowledge. So all that we have gone through, the reason why those are the key things to look at. Then there are factors to consider when choosing the right fund manager. Some of them is the track record, the transparency of the fund manager, and then diversity. Always make sure that you go to a fund manager who has diverse products, so that they can actually advise you correctly on what to invest in. So I just decided to look at the key players in the unit trust market, and this is the data for the end of 2019. The largest provider is CIC Asset Managers, with a portfolio of about 30 billion. And then looking at the funds that grew fastest is actually Saturn Asset Managers, whose funds grew from 62 million to about 717 million. So if you look at this in totality, you can actually see what the key players. So knowledge is important. It's always good to know, why am I investing with CIC and not maybe, for example, Equity Investment Bank and things like that. It's just good for you to understand who are the key providers, who can I speak to if I want to invest in this particular investment. So the other thing is yield, or the return that you're getting. So I just decided to take the returns that were declared yesterday by the various money market funds, and the highest there again is set on money market at 11%, compared to something maybe like Old Mutual, which had a return of 5.828. And all this information is in the public domain because it's in the newspaper. So that will be the end of our